Chapter 1. Scope and objectives of financial management. Meaning of financial management. Financial management deals with procurement of funds and effective utilization of funds in business. Managerial activity which is concerned with the planning and controlling of the firm's financial resources. Decision-making process concerned with acquiring, financing, and managing assets to accomplish the overall goal of a business organization. The process of planning decisions in order to maximize the shareholders' wealth. Financial management comprises the forecasting, planning, organizing, directing, coordinating and controlling of all activities relating to acquisition and application of the financial resources of an undertaking in keeping with its financial objective. Finance function 1. Procurement of funds. Funds procured from various sources have different characteristics in terms of risk, cost and control. Funds can be procured from banks and financial institutions subject to certain restrictions or retention of profits, also called retained earnings. The cost of funds should be minimum. A proper balancing of risk and control factors becomes essential. Procurement of funds involves the following: identification of sources of finance, determination of finance mix, division of profits between dividends and retention of profits, raising of funds. 2. Effective utilization of funds. It is crucial to employ them properly and profitably. Funds should not be kept idle. Idle funds have opportunity cost. Finance manager is responsible not only for procurement of funds but also for its effective utilization, identifies the areas where funds remain idle and why they are not used properly, analyzes the financial implications of each decision. Main characteristic features of sources of funds. 1. Own funds. Equity. Low risk. No question of repayment of capital except when the company is under liquidation. No obligation to pay dividend. Most expensive. Dividend expectations of shareholders are higher than interest rates. Also, dividends are not tax deductible. Dilution of control. If the capital base is expanded due to the involvement of new shareholders, public, then the issue of shares is said to dilute the control. 2. Preference shares. Riskier than equity, but less risky than debentures or loans. Dividend is paid only out of profits, in priority over the equity. No security is provided to preference shareholders. Obligation to redeem the preference shares on maturity. Costlier than debentures, but less expensive than equity. Dividend is not tax deductible. No dilution of control. Exception. In case of cumulative preference shares, if dividend is not paid for 2 consecutive years. 3. Loan funds. High risk. Capital should be repaid as per agreement. Interest should be paid irrespective of profits being made. Comparatively less expensive. Rate of interest is lower than rate of preference dividend. Also, interest being a tax deductible expense, it makes effective cost much lower. No dilution of control. Exception. When loan is taken from financial institutions, they may appoint nominee directors. Banks and financial institutions may impose restrictive provisions on raising loans from other sources, end use of funds, etc. Evolution of financial management. 1. Traditional phase. During this phase, financial management was considered necessary only during occasional events such as takeovers, mergers, expansion, liquidation, etc. Also, when taking financial decisions in the organization, the needs of outsiders to the business was kept in mind. Routine financial problems were ignored. 2. Transitional phase. During this phase, the day-to-day problems that financial managers faced were given importance. The general problems related to funds analysis, planning and control were given more attention in this phase. 3. Modern phase. Modern phase is still going on. The scope of financial management has greatly increased now. It is important to carry out financial analysis for a company. This analysis helps in decision making. During this phase, many theories have been developed regarding efficient markets, capital budgeting, option pricing, valuation models, and also in several other important fields in financial management. Scope of financial management: profit making or non-profit making. A non-profit organization needs to cut down its cost and use its funds at their optimum capacity. New or old company. New companies need financial management for the growth and development in this competitive world. Old companies need financial management for their survival and further growth. Small or big company. Financial management is essential for a small as well as big company, though to a different extent. All departments need funds to be managed well and hence need financial management, e.g., production department, marketing department, personnel department, research department, administrative department. Objectives of financial management: 1. Profit maximization. The finance manager has to make his decisions to maximize the profits of the concern. Profit maximization is viewed as a limited objective, i.e., essential but not enough. Advantages: must for survival of business, else capital is lost. Essential for growth and development of business, societal impact and reputation. Profit is regarded as the yardstick for judging the economic efficiency of a firm. Profit-making firms only can pursue social obligations. Disadvantages, limitations, is vague and ambiguous, conveys different meaning to different people. Profit may be in short-term or long-term. It may be total profit or rate of profit. It may be profit before tax or profit after tax. Higher the profits, higher the risks involved. The finance manager will accept highly risky proposal, ignores time pattern of return. The term profit considers costs and returns in the absolute terms without considering the timing of return, time value of money. Ignores social and moral obligations of business. It fails to consider the obligations to various interests of workers, consumers, society as well as ethical trade practices. Profits calculations can be influenced by accounting policy. 2. Wealth maximization. The objective of a firm should be to maximize its value or wealth. The wealth maximization objective of a firm considers all future cash flows, dividends, earning per share, risk of a decision, etc. Wealth maximization, as an objective, means that the company is using its resources in a good manner. If the company follows the goal of wealth maximization, it means that the company will promote only those policies that will lead to an efficient allocation of resources. Wealth or value of a firm is represented by the market price of its shares. The market price of a share reflects the shareholders' expected return, considering the long-term prospects of the firm, reflects the differences in timings of the returns, considers risk and recognizes the importance of distribution of returns. If the share value is to stay high, the company has to reduce its costs and use the resources properly. Better objective for a business since it represents both return and risk. Advantages. It is unambiguous since it clearly explains what wealth refers to. Emphasizes on long term. It considers all future benefits flowing from the firm to the shareholders. Recognizes risk or uncertainty. Recognizes the timing of returns by using discounting techniques. Considers shareholders' return disadvantages. Offers no clear relationship between financial decisions and share price. Can lead to management anxiety and frustration. Decisions taken by finance manager to achieve wealth maximization. 1. Investment decisions. These decisions determine how the resources available are committed to projects, which can range from acquiring a piece of plant to the acquisition of another company. The investment of funds in a project has to be made after careful assessment of the various projects through capital budgeting. A part of long-term funds is also to be kept for financing the working capital requirements. 2. Financing decisions. These decisions relate to acquiring the optimum finance to meet financial objectives and seeing that fixed assets and working capital are effectively managed. The financial manager needs to possess a good knowledge of the sources of available funds and their respective costs, and needs to ensure that the company has a sound capital structure, i.e., a proper balance between equity capital and debt. Financing decisions also call for a good knowledge of evaluation of risk, e.g., excessive debt carries high risk for an organization's equity because of the priority rights of the lenders. 3. Dividend decisions. These decisions relate to the determination as to how much and how frequently cash can be paid out of the profits of an organization as income for its owners, shareholders. The dividend decisions thus has 2 elements: the amount to be paid out and the amount to be retained to support the growth of the organization, the latter being also a financing decision. The level and regular growth of dividends represent a significant factor in determining a profit-making company's market value. Functions of a finance manager. 1. Fund requirement estimation. The requirements of funds must be carefully estimated. The purpose of funds, investment in fixed assets or working capital, and timing of funds, i.e., when required, should be determined. This involves the use of techniques like budgetary control and long-range planning. This calls for forecasting all physical activities of the organization and translating them into monetary terms. 2. Capital structure. Financial decisions. Funds can be procured from various sources for short-term and long-term purposes. Decisions regarding capital structure, called financing decisions, should be taken to provide proper balance between a. long-term and short-term funds, b. loan funds and own funds. Long-term funds are required to a. finance fixed assets and long-term investments, and b. provide for permanent needs of working capital. Short-term funds are required for working capital purposes. A proper mix of various sources must be worked out by the finance manager. 3. Investment decisions. Funds procured should be invested, utilized effectively. Long-term funds should be invested, a. in fixed assets, projects after capital budgeting, and b. in permanent working capital after estimating the requirements carefully. Asset management policies should be laid down for fixed assets and current assets. 4. Dividend decisions. The finance manager assists the top management in deciding as to a. what amount of dividends should be paid to shareholders, and b. what amount should be retained in the business itself. Dividend decisions depend upon numerous factors like a. trend of earnings, b. Trend of share market prices. C. Requirement of funds for future growth. D. Cash flow situation. E. Tax position of shareholders. 5. Cash management decisions. The finance manager has to ensure that all sections, branches, factories, departments and units of the organization are supplied with adequate funds, cash, to facilitate smooth flow of business operations. He should also ensure that there is no excessive cash, idle funds, in any division at any point of time. For this purpose, cash management and cash disbursement policies should be laid down. 6. Performance evaluation. The finance manager must evaluate financial performance of various units of the organization. There are various tools of financial analysis, viz. budgetary control, ratio analysis, cash flow and fund flow analysis, common size statement analysis, intra-firm comparison, etc. Financial analysis helps management to assess how effectively the funds have been utilized and to identify methods of improvement. 7. Financial negotiations. The finance manager is required to interact and carry out negotiations with financial institutions, banks and public depositors. Negotiations, especially with outside financiers, require specialized skills. 8. Market impact analysis. The finance manager must keep in touch with stock exchange quotations and behavior of share prices. It involves analysis of major trends in the stock market and judging their impact of the share price of the company. Value maximization objective is achieved through this analysis and action. Role of Chief Financial Officer, CFO. A. Financial analysis and planning. Determining the proper amount of funds to employ in the firm, i.e. designating the size of the firm and its rate of growth. B. Investment decisions. The efficient allocation of funds to specific assets. C. Financing and capital structure decisions. Raising funds on favorable terms as possible, i.e. determining the composition of liabilities. D. Management of financial resources, such as working capital. E. Risk management. Protecting assets. Typical organization chart depicting the finance function. Refer. Text role of finance manager in today's dynamic environment. Freedom in pricing of securities. Vital decisions of allocation of capital, e.g., mergers and acquisitions. Emergence of financial services, e.g., mutual funds, housing loans, consumer finance, etc. Capital market regulations, e.g., SEBI, Companies Act. The finance manager has to constantly update himself with the latest provisions of law, innovative tools of raising finance, e.g., deep discount bond, zero coupon bonds, promotion of shareholders' interest due to increased competition, use of information technology. A finance manager needs to know how to integrate finance and costing with operations through software packages including ERP, e-commerce, globalization, competition at international level, raising of funds from international sources, e.g., ADR, GDR, foreign direct investment, FDI, and foreign institutional investors, FII, foreign collaboration and joint ventures, investment outside the country. Tools of financial management. 1. Financing decision. To maximize wealth of shareholders, optimum capital structure, proper debt-equity mix, financial leverage. Trading on equity, EPS analysis. 2. Investment decision. to maximize return on investment. Made, capital budgeting techniques, payback, average rate of return, net present value, internal rate of return, profitability index, etc. 3. Performance evaluation decision, budgetary control, ratio analysis, projected financial statements, cash flow and fund flow analysis, etc. 4. Working capital management, to maintain liquidity, ABC analysis, economic order quantities, EOQ, cash management models, relationship between finance function and other functions. Finance is defined as the life and blood of an organization. It is the common thread that binds all organizational functions. Each function in an organization has financial implications. 1. Finance and production, investment aspect. This includes decisions on investment in inventories, purchase of new asset, stock levels, purchase policies, etc. Expansion, decision-making aspect. Decisions such as make or buy components, retain or replace machinery, etc. are taken after analyzing financial implications thereof. 2. Finance and marketing, investment aspect. This includes decisions on investment in finished goods, inventories, advertising, sales promotion, credit period, decision-making aspect. Marketing, decisions and strategies such as credit granting, change in sale prices to sell additional quantities, acceptance of additional order, etc. are taken after analyzing their financial impact. 3. Finance and personnel, investment aspect. This includes decisions on capital costs associated with personnel policies, substantial training expenditure, recruitment, promotion, voluntary retirement scheme, VRS, decision-making aspect. Investments in HRD are bound to increase in future. Restructuring of pay package, drafting of voluntary retirement schemes, etc. are some major decisions in human resource management. 4. Finance and research and development, investment aspect. Lots of funds are required for research and development purposes. Companies must come out with new product, new models to face the tough competition. Decision-making aspect. Large sum of money needs to commit. Financial accounting versus financial management. Financial accounting, an accountant's job is mainly concerned with maintaining financial records, ensuring proper classification of transactions under assets, liabilities, income and expense groups, preparing financial statements, etc. Accounting is performed at medium and lower level in the organizational hierarchy. It deals with past events, i.e., the transactions which have already occurred. Accounts are maintained on accrual basis. It is more related to measurement of funds. Financial management, finance manager, handles the task of procurement and optimum allocation of funds, keeping in mind risk, cost and control aspects. Financial management is performed at top level in the organization. It is future-oriented. It deals with estimated transactions. Finance manager uses cash basis since he decides about availability of funds not only for present but also for future. It is more related management of funds, financial management and an understanding of taxation policy and provisions. Tax considerations influence these areas and hence the finance manager needs to have a reasonable understanding of direct and indirect tax provisions. Financing decisions, cost of capital. Debt is cheaper than equity since interest payable on loan is a charge on profit and will reduce the tax payable by the company. The use of cheaper cost debt funds has a leverage effect and increase the EPS of the company. Investment decisions, capital budgeting, for project evaluation. The cash flows after taxes, CFAT, are relevant for discounting purposes. Cash outflows may also be reduced due to various deductions and allowances. The incidence of tax on income and on capital gains affect cash flows and investment decisions. Dividend decisions. Retention v. payment. Tax is one of the major considerations in taking decisions on the amount and rate of dividend. Whether the company should retain all its earnings or distribute all earnings as dividend also depends on tax incidence on the company and its shareholders.